Hi, I'm Chuck Inglefield, founder of Inglefield Retirement Solutions. My specialty is helping retirees manage their plans so they don't outlive their money. This is my economic update for the second quarter of 2025. A lot has happened in this quarter, so let's go ahead and dive right in. For those of you in a hurry, here's the bottom line. I encourage you to pause the video right here and you can read through this. I won't take the time to do that. For those of you who want to stick with me, I'm going to put a lot of context around these topics. Also, you will see chapters on the videos if you just want to jump ahead and look at something specifically. Here's the agenda for today's conversation. We saw GDP drop in the first quarter of this year, and I want to talk about that. Also, we're going to look at what is the impact of the tariffs on the economy. That's actually put the Fed in a tough spot. We'll talk about their predicament, talk about what business and consumers are telling us, and finally, how to keep your retirement plan on track. Let's start with a look at the drop we had in GDP in the first quarter. Is that real pain we're seeing? Is that the beginning of a recession, or is that just noise? So this is the first drop in GDP that we've seen since 2022. GDP came in at negative 0.3% for this first quarter. It might be a little bit deceiving from the headline because GDP went negative for one reason. You see it right here on this slide. There was a surge of imports in the first quarter with businesses and households trying to front run the tariffs that were going to be implemented. That had a big impact on the GDP number for Q1. Now, I know all of you have been wondering, hey, how do you calculate GDP? Of course, you haven't been, but in this case, it's important to take a deeper dive and look at this. It's made up of a number of things, consumer spending being the biggest component. That's about 2/3 of GDP. But this last part of the formula, exports minus imports, is where the distortion came in from those large amount of imports. When you have imports rising dramatically like they did, that actually subtracts from GDP and makes it look like there's a contraction in the economy. In fact, because of that surge in imports, we saw GDP negative when if you removed the imports piece of this formula, which isn't really fair, but if you did remove it, you actually saw GDP or positive around 2% or around the trend line that we've seen over the last few years. So behind those headlines, and I was encouraged to see that most of the news outlets reported this responsibly, but GDP was down in the first quarter, but it's because those imports up 41%. Without that import surge, GDP would have been positive. The one thing that bears watching here, though, is consumer spending, although growing, is growing at a slower pace at 1.8% versus the 4% annualized pace that it grew in the first quarter. And because consumer spending is a big part of that GDP calculation, that's something to look at if we're seeing real contraction. One other point I want to make here is that the GDP for the second quarter is likely to be higher than normal because of the inventory that was pulled forward in the first quarter. We're going to see the reverse effect of that. So we might see GDP over 3% in the second quarter, while at that time, some of the other parts of the economy might be weakening because of the tariffs. So in the last quarter, and I think in the next quarter, we're really going to have to dig a little bit deeper to see what's going on with economic growth. Let's move on to talk about the tariffs themselves and then what they're really doing to the economy. Let's first put the tariff magnitude into context. It might be hard to see, but on the very right side of this slide, you can see a gray bar. But if you can't see that, you can just look where the arrow is. And that is the proposed level of tariffs we're currently looking at. And if you go back through history, and we're looking back over 100 years here, the last time we had tariffs this high was 1929, also known as the Great Depression. So let's hope that it works out better for us this time. Obviously, the state of tariffs is in flux right now, so it's very possible we will not have levels that high, but it definitely can create a challenge for the economy. Let's take a look at what it might do to GDP. In the short term, estimates are that it will pull almost a percentage point off of GDP. Over the long run, maybe 0.6% reduction in GDP. So bottom line, slower economic growth. We're going to see our exports decrease over 18%, and unemployment is going to increase. Here we see 740,000 jobs estimated to be lost as part of the tariffs that are being implemented. A good example of where we'll see something like this is at our ports. If we see imports and exports declining, there's going to be less activity at ports, which means they're going to need less employees at the ports. And there's a domino effect throughout the economy. If business slows, it's very possible that we'll see more layoffs. So that's how the unemployment situation might play itself out. The reason for the tariffs is very important because it's going to indicate to us how long they're going to stick around and in what magnitude. So the administration has said that there are two reasons for the tariffs. The first is that they want to negotiate fair trade deals. The second is to fund the tax cuts that are currently being negotiated. If it's to negotiate fair trade deals, that's really a short-term pain, long-term gain scenario. The idea being that, yes, it's definitely going to slow the economy in the short term, but the fair trade deals will help us in the longer term. There should be less economic damage because I think there's going to be a quicker resolution in that scenario, which means businesses and households can begin to plan and grow, where right now there's so much uncertainty, it's hard for them to do so. If the primary reason is to fund the tax cuts, this is a longer term drag because you're going to need that tariff revenue to continue to fund those tax cuts. And that has a real risk of economic harm. It's definitely going to slow growth. And the longer it sticks around, you've got a higher recession risk, especially if the tax cuts might flop. What's interesting is I've heard a number of economists, they started the year with a 25% probability estimate for a recession this year. Now the average is somewhere over 60%. In fact, over the last week, I've heard estimates over 75%. So we'll see how that goes. Again, a lot of this can change quickly once we learn more about what actually might happen with the tariffs. All of this puts the Fed in a tough spot. When we look at their challenges, the Fed is data driven. As we just saw in the GDP number, the data isn't at face value what they're going to be looking at. They're going to try to do a deeper dive. But a lot of the job data specifically tends to lag the actual economic environment. So we got a good jobs number on Friday. They actually revised the month before number down by about a quarter of what it was. Jobs tends to lag, and lagging data, if they're data driven, has the increased possibility of them making a policy error or being too late when they need to make an adjustment to their interest rate policy. The Fed has a dual mandate. They want to keep unemployment low, and they want to keep inflation in check. And the medicine for each of those is different. So to keep unemployment low, they will tend to lower interest rates to stimulate economic activity. If inflation becomes a problem again, like it was, it's moderated. But if it becomes a problem again, the medicine is higher interest rates. So that's where they are. It's a tricky part, and which one of these is going to take precedent, because tariffs will slow the economy and create inflation. Which is the bigger problem? That's what the Fed has to work on, and they're doing so with possibly lagging economic data. I want to show this slide. Bloomberg put this in an article this last week. I thought it was a really good indicator of where the priority might be. So on the left side of this slide, you'll see that this is the market's estimate of potential interest rate cuts for this year. So at the beginning of this year, the market was estimating 1 to 2 rate cuts during this year. Like the Federal Reserve is going to drop rates maybe a quarter of a percentage point 2 times. Since the tariffs have been announced, now you see the market's estimating 3 to 4 rate cuts this year. What the market's saying is the bigger risk right now is an economic slowdown, not inflation. Although inflation expectations, as we'll see on the right side of the slide, have gone up from the beginning of this year. The market was expecting, hey, we think inflation is going to run around 2.5% this year. But since the tariffs have been announced, that's easily over 3, closer to 3.5% this year. The Fed's going to have to fight that battle. But right now, the economic slowdown might be the bigger of the two battles they're going to have to fight, which means lower interest rates. Let's move on and talk about what we're seeing from businesses and consumers and what that might be telling us about where we're headed with economic growth or contraction. Let's start with businesses. And I know you can't see the slide very well, so I want to zoom in on the chart on the upper right, which is about business confidence. So with business confidence, we're seeing a similar situation to what we saw during COVID. We can see here that business confidence has plummeted since the announcement of the tariffs. The dark line is businesses, and the blue line is actually small business optimism. Both have pulled down to levels we saw during COVID, which to me was one of the most uncertain times that we've had, just because of the uncertainty around the tariffs. An outcome of this has been that a number of companies have withdrawn their earning guidance for 2025. You can see the automotive companies, the airlines, UPS, Procter and Gamble, all these big companies have said, hey, we really don't know what the tariffs are going to do to our business this year. So we're not going to put out estimates for earnings. I don't see that changing until we get more certainty around tariffs. This creates its own challenge because businesses, they've hit the pause button because they just don't know how to plan for the near or long-term future with the tariffs so uncertain. In fact, if you think about what might be going on in boardrooms right now, I think there might be a version of this. Hey, we need to update our forecast. Heads, this will blow over soon. Tails, it's the end of the world. So for a joke or a comedy to be funny, there's got to be an element of truth involved. And I think there's quite an element of truth here. Let's turn our attention now to the consumer. For the consumer, we see two things happening. Number one, consumer confidence has plunged. That's not really a surprise because as it's done for businesses, the tariffs have created uncertainty. In fact, we saw a reaction in the stock market right away when the tariffs were announced. Interestingly here, also their expectations have reached a 14-year low. So expectations are being defined as business conditions, their employment prospects, and their expectation for future income. And that has also plummeted. The risk here is that this is going to cause them to stop spending. And this slowdown can be a self-fulfilling prophecy. Again, 2/3 of GDP growth is consumer spending. If consumers stop spending because they're nervous, because they've lost confidence, we've heightened the probability of a recession this year. Let's take a look at the actual dollar impact that people might see from the tariffs as they've been announced. If you're in the lower income range, tariffs might cost around $1,700 a year, which is a 5.7% portion of your disposable income. If you're in the middle income group, $3,800 a year, 5% of your income. If you're in the $200,000 plus group, $8,100 or about 1.6. So I would say that's not really going to change their lives, but these dollar amounts for these larger income households definitely will catch your attention. The impact here is that as people see prices rise, they're going to pull back their spending behavior, or they might delay taking that trip. So far, we actually haven't seen the cost of the tariffs yet. We'll start to see that over the next quarter. That's where we really need to pay attention to what's happening with the consumer to give us an indication of whether we are headed for an economic slowdown or a recession. All of this uncertainty creates a challenging environment for us as investors. How do we navigate this and keep our retirement plans on track? One of the most important principles is diversification. And here's a chart that's impossible to see. So I will read to you what I think is important data on this slide. So this essentially periodic chart almost shows the different investment asset classes and how they've performed each year. Each column represents 1 year and each colored box represents one asset class. And if the box is at the top of the column for that year, it was the best performing asset class. If it was at the bottom, it was the worst performing asset class. Let's just take a look at year to date so far. And the best performing asset class is developed international, followed by emerging markets. So developed international was up 12%. Large cap US was down 5% through that same time period. It's a huge differential, about 16-point differential. Bonds were up about 3. So an asset allocation portfolio is right at break even or slightly above break even. And it's because of the international investments in the bonds in that portfolio, while the US markets have had their pullback. You can see the asset allocation portfolio is the light colored box here, and it's never at the top It's never at the bottom. And going back to 2010, the average annual return for an asset allocation portfolio in this scenario is over 10%. That is the power of diversification. As retired investors, the number one thing with regard to portfolio management is to not make mistakes. Don't concentrate your portfolio in any one asset class and stay diversified. I know the market volatility recently caught everybody's attention. Did you see terrified or terrified? Let's put the recent market volatility into context. I show this slide almost every quarter, and what it shows is the bar chart of the S&P 500 going back to 1980. Each bar represents the performance of the S&P in that one particular year. So you can see last year the S&P 500 was up 23%, but it also shows how far down the S&P was during any given year. And that's the red dot. So year to date, the stock market was down 5%. It feels like it was down more than that. And that's because we essentially had a bear market this year. So from peak to trough, the market closed down 19% at one point during the year, and it's come back quite a bit over the last 2 weeks, although we're still 7.5% down from the high back on February 19th, I believe was the date. This is slightly above average as far as pullbacks go. The average pullback in any given year is 14.1%. In fact, when I created my last video, we were down about 12%. So we've definitely come back since then, but we're not seeing anything outside the norm for the most part. It just has caught our attention because the swings daily have been larger than we've seen in quite some time. What that'll do to us is emotionally, it makes us think, hey, we've got to do something. In fact, there's always a reason to sell stocks. I've been doing this 27 years, started right before the dot-com bust. That was a big reason to sell stocks. We had the Great Recession, 08, 09. You had COVID, which to me was the most uncertain point because it was impossible to measure how long that might last and what the impact was going to be. And the uncertainty we're seeing recently, really self-imposed from the tariffs, is driven by us not knowing how long the tariffs will be in place and at what magnitude. One thing that's always been true, especially for a retirement time horizon, is to stay the course and not sell stocks. I shared with you in the last video a version of this data, and I thought JP Morgan did a really good job here. And it's showing the returns of the S&P 500 going back 20 years. If you invested and stayed fully invested, the return on that portfolio was 10.4%. If you missed the 10 best days, your return was closer to 6%. So you gave up 40% of your return. If you missed the 20 best days, you were at 3.5%. If you missed the 30 best days, you should have just bought a CD. A good friend of mine who is an engineer and frankly was a rocket scientist said to me, who actually misses the best 10 days? You seem like you're cherry picking the data. And I said, fair point for sure. But behaviorally, what happens is people tend to get scared out of the market and they don't get back in until they feel better, which is way after the market has recovered. I really like what JP Morgan included on this slide, which is this data. 7 of the 10 best days occurred within 2 weeks of the 10 worst days. Behaviorally, what happens is people get scared out of the market. It would have been very easy to get scared out of this market right after the tariffs were announced. And people don't get back in quickly. They wait until they feel better, and by then, things have recovered. If you missed April 9th, you're not recovering from this. The S&P 500 on that one day was up 9.5%. The NASDAQ up 12. The Dow Jones only up 7.8 in one day. If you had jumped out and gotten scared from the initial market drops and missed this recovery day, your portfolio is going to look like those I just showed on the prior slide. You've given up a portion and probably a big portion of your returns as part of that recovery. I put together a slide that I showed back during the Great Recession, and it was to make the point of don't miss the market bounce. And behaviorally, it's easy to do this because you won't jump back in. If you jumped out, you're not going to jump back in soon enough because the majority of the market bounce happens in the first 90 days. So going back to the dot-com bust, 12 months from the bottom of that bear market, the market was up 34%. 18% of that 34 happened in the first 90 days, or 53% of that recovery happened in the first 90 days. If you look at the Great Recession, the market was up 68%. 58.3% of that return happened in the first 90 days. COVID, market was up 74.8% over the next 12 months after that market bottomed. 56.8% happened in the first 90 days. And then we had the bear market of 2022. Same thing. The first 90 days is when the big bounce happens. And if you miss that, and I would say behaviorally, if you got scared out of the market, you haven't gotten comfortable with it after the first 90 days from the bottom, because the news still doesn't sound good. You would miss a big part of that recovery. So as long as I've been doing this, and I know this in my bones, don't jump out and try to time markets. Stick with your plans, stick with your diversified portfolio, and that recovery, when it comes, will provide a meaningful impact on your overall returns. I want to wrap up with one little point of optimism here. I said earlier that consumer confidence was in the cellar, and it is. You can see this University of Michigan survey, my alma mater, shows that consumer confidence has plummeted again this year. And we don't know if it'll continue to go down or not, but consumer confidence has been a fairly reliable contrary indicator. Contrary meaning what happens with the markets is contrary to what you would expect, given what the data point is showing you. So you would expect that, hey, the market's going to tank because consumers are not confident. That's not necessarily the case. In fact, this data in the small box on the upper left shows that at the very bottom of those consumer confidence points, if you measure what the S&P return was 12 months after that, it's 24.1%. So we may actually already be in that recovery from this point. But when I see consumer confidence reaching lows, to me, it says, hey, a lot of the risk has already been priced into this market, and there's more opportunity for upside from here if history continues to repeat itself. I want to conclude with 2 slides about just focusing on what matters. I saw this quote recently I really like, which is, don't disturb the calm you've earned just to match someone else's chaos. Life's just too short to chase headlines. Don't change your plans. Don't let this volatility scare you from doing what it is that you've worked hard to do and you'd like to do. Go ahead and take that trip, renovate that bathroom, enjoy all that you've worked hard for. And heck, just look for deals on these things while others are living nervous lives. I appreciate your time and attention this quarter. Remember to like this video if you appreciated the content. Also, if you haven't subscribed, go ahead and do so and hit the notification bell, and you'll be notified every time I post new content. Thank you, and I hope everybody has a great quarter.